Today we're going to start with the basic definition of accounting. And then we're going to go through the two financial statements. And then we are going to go through the uses of financial statements. Uses of financial statements, okay? All right, so by definition, accounting is a discipline that deals with, one, recording economic information. Recording economic transactions. Once we record it, two, we summarize them in the form of financial statements. And then C, we communicate that information to users of the financial statements for purposes of the decision making. Okay? So that is my definition of accounting. Accounting is the discipline that is concerned with recording economic transactions and also concerned with summarizing those economic transactions for purposes of communicating them to users of financial statements who will use that information to make decisions. Does that make sense? Let's expand on it a little bit. What do I mean by economic transactions? In accounting, if information has monetary value, it is economic. We want to record it. And that is what we record in the form of the financial statements, which we know to be the P&L, the profit and loss account, the balance sheet, and then the statement of cash flows. These are the main primary tools that we use in accounting to communicate. Profit and loss account, also called the income statement, the balance sheet, which is a picture of our assets, liabilities, and equity, and the statement of cash flows, which shows us how much cash came in, how much cash went out, and why. We're going to do that, right? And so, if it is monetary transaction, we record it. If it is important, non-monetary, but it's important, we will just disclose it. We disclose it for information purposes, okay? So it doesn't mean that we don't care about the non-monetary information. We do care about the qualitative information, especially the risks associated with those transactions, but we disclose them in the notes to the financial statements. Does that make sense? All right? So we communicate this information to users of financial statements, and typically we communicate them on a quarterly basis. Quarterly basis. That means every 3 months. So January, February, March is first quarter. And so in April, we will be reporting information for the first quarter. And April, May, June is the second quarter. So in July, we will be reporting information for the second quarter and the first quarter, year to date. Does that make sense? And then July, August, September is the third quarter. And in October, we're reporting information year to date for the first 9 months of the year, and also just for that quarter as well. And then October, November, December is the fourth quarter. So in the fourth quarter, we report all the information for that year. And in January, we will be reporting that information. So if you're an accountant, it is fair to say that January is the wrong time to take vacation, because it's when you're going to be closing the books for the year end. You're going to be very busy in January. Hopefully in February, things would have eased out and you should be able to take vacation. So quarterly, annually, annual reporting of information, and we are going to communicate that information to internal and external users. The internal users of financial statements are management and employees, management, employees, and people who are inside the company, within the company, the board of directors, correct? And then the external users of financial statements will be investors, banks, regulators, creditors. These are some of the interested parties in the information that we are going to provide. Does that make sense? All right. And then we will also make sure when these people get this information, after we communicate the information to the users, I mean, how do we communicate that? You can put it in the form of, you can also do it on the company's website, company websites, or you can do it on the SEC website. If you are a public company, you put the information on the website of the Securities and Exchange Commission, SEC. Does that make sense? They have a website. Public companies are required to upload that information up there on the SEC website. And so most companies do that. But if you're a private company, you will put it on your own website and people will be able to go there and get that information that you have put there, okay? What type of decisions will people use financial accounting information for? You know, when the investors get the financial accounting information, they want to be able to assess whether the company is profitable. Is it a profitable company? And is that profitability likely to be sustained over time, over a long period of time? Is this company going to fold up or is it going to be good? They can also use that information to assess the liquidity or the cash, nearness to cash of the company. They could also assess the solvency, which is how much debt versus equity they have in the company. And they can also use that information to measure activity or asset effectiveness, okay? Asset effectiveness. How good is the company in using their assets to generate revenues? So for example, they may calculate an asset turnover ratio, and the asset turnover ratio may be calculated as your sales divided by your total assets. You can see that the sales is coming from the income statement, sales revenue, and the total assets is coming from the balance sheet. Therefore, we're going to call this a mixed ratio because one number comes from the income statement, one number comes from the balance sheet. So this is what we call the asset turnover ratio. Asset turnover ratio. And you may calculate this, and let's say the assets is 100, the sales is 100, and your total assets is, let's say, 50. So that gives you a 2 times. That means that the company is able to generate 2 times the value of the assets with the assets that they have. 2 times in sales, right? So they have assets of 50, but they're able to generate double it in sales. So they are effectively using their buildings, they are effectively using their cash, they are effectively using all their resources to generate sales. So an activity ratio of, let's say, 2% suggests that it is good. You might also use this information to determine information about the market risk or price. Is the company fairly priced if it's a public company? Is the stock price fair or not fair? Yes?
Sorry, what does the TA stand for?
Total assets. Total assets. The TA is total assets of the company. Great question. Great question. Any other questions so far? So some of these are some of the information that people may get financial statements and use that to make those decisions. Now I'd like to zoom into the financial statement itself, which is number 2. In order to do that, I'm going to erase some of this. Is that fair? Good to erase it? Okay. Now let's go into the financial statements one by one and make sure you really understand the financial statements. All right? That is good stuff. So the first financial statement that we're going to prepare, or if you like, you can look at it in terms of the accounting cycle. First thing is we're going to have our ledger, which is just the place where we are going to record all the debits and credits, right? This is our ledger. And you can have a subsidiary ledger, and then you can also have a general ledger. And then you may also have control accounts. Control accounts. These are total accounts. So this is kind of where you may have QuickBooks, you may have S&P, you may have computer software to help you with all this stuff, right? So the general ledger, for example, may record things about all fixed assets, may record things about sales, revenue, accounts receivable. Well, you may have small little ledgers that support the general ledger, and we're going to call those small ledgers subsidiary ledgers. And then if you really want to know how we're going to transfer this information from the ledger, we're going to transfer it into something that we call a trial balance. Trial balance. And the trial balance is just to check the mathematical or the arithmetic accuracy of this bookkeeping process, this ledger process, right? Because we started off with an assumption that every debit needs to have a credit and vice versa. That is the double entry principle, correct? That you learned in your principles class. Every debit needs to have a credit and every credit needs to have a debit, right? So if all I'm doing here is debit and credit, increase and decrease, then when I finish, all my increases and decreases need to tally, they need to be the same, right? But that's what I started doing. So to check that the debits are equal to the credits, I do what we call a trial balance, a TB. And on the trial balance, all I'm going to do is I am going to have all my debits here, and I'm going to have all my credits here, and I will start off with my assets, how much, my liabilities, my equity, my revenue, and then my expenses. So this is basic trial balance, correct? So I might say that my assets are, let's say, 100. My liabilities are, let's say, 80. You know from the accounting equation that asset minus liability equals what? Equity. So my equity, by definition, to start with is 20. Does that make sense? Don't forget the accounting equation that we use to record the stuff in the ledger. All right? And then let's say I come to my revenues and I say my revenue is 200. And then my expenses, in this instance, let's say I say that my expenses are 180. 180. So this trial balance will say, before you prepare the income statement, I want to know if the sum of your credits are equal to the sum of your debits. So I look at it this way, and I say this plus that is 100, plus that is what? 300. So I expect this to be 300, but it is what? 280, right? So something is not quite right, but I'm going to force it to balance by putting 300 here and try to figure out what is that 20. When I prepared the income statement, is going to tell me that, well, your revenues are more than your expenses, so you should expect a profit of 20, right? In this particular instance. Does that make sense? All right? And so this is what we call the trial balance. The problem with this trial balance is that it is focused on debits equal the credit, but it doesn't take into consideration what we call adjustments. Adjustments. So the adjustments typically include things like, one, depreciation expense. Expenses. You had furniture, you had buildings, you had computers that you used. And the use of those assets, those fixed assets, is what we're going to call depreciation. So if the cost of the asset is $1,000 and you expect to use it over 10 years, then we estimate that you may have used what? $100 each year. Does that make sense? So this is what we're going to call depreciation expense. And what are we going to do with this depreciation expense? Always we're going to do is we're going to debit and credit, because we always debit and credit. So you have to write that down. And then you think a little bit. What are you going to debit? Depreciation expense. And then you're going to credit something that we call accumulated depreciation. That means total depreciation, accumulated depreciation. Okay? And if in fact this whole thing is for the year, then this will be 100 and this will be 100. Does that make sense? So that is your first adjustment that you should learn. Your second adjustment that you should learn is what we call accruals, accrued expenses. Accrued expenses simply means that you have used an asset, you've stayed in somebody's apartment like rent, but you haven't paid them yet. Because normally you pay your rent maybe on the 1st or the 16th of the month, even though you used it for the previous month. Does that make sense? So how much is your rent? You say it's $500. And I say, okay, did you stay in the apartment during the month of August? And you said, yes. Have you paid it yet? You said, no, I haven't paid it yet. We still want you to record the accrual because you've used the apartment. Does that make sense? So accounting is not just based on cash, but it's based on what? Use and earnings principle. So if you have an accrued expense, you need to debit accrued rent. And then you need to credit the liability. So rent expense, in this case, needs to be debited. In the example, let's say it's $500, and then the credit is going to be accrued rents. And this is a liability, accrued rent liability, 500. Does that make sense? That's the accrual. And another example of the accrual principle is salaries. Normally, people work 2 weeks and then they get paid. So from the viewpoint of the company, at the end of the month, they need to remember that people have worked for them and that they would have to pay them in the future. Does that make sense? So you may record an accrued salary. The consistency is that whenever you have an accrual, you need to debit the expense and you need to credit what? The liability. Does that make sense? So debit accrued salary expense, credit accrued salaries payable. So the word payable, the word liability, the word accrued, it means the same thing. That means it's a liability. Does that make sense? So we may use those words interchangeably. Make sense? The third type of adjustment that you need to be aware of is prepaid. Prepaid expenses. Typically, this is an asset, right? And the reason why it is you have paid money to another organization, another person, but you have not used it yet. And an example is your car insurance. You paid, let's say, $1,200 for the whole 12 months, but we are in the beginning of September. So you still have about October, November, December that you haven't used yet. So yes, when that happens, we are going to make sure that you debit and then you credit. You debit your prepaid asset, and then you credit what? The prepaid expenses. By how much? So if the total for the year is $1,200, and you divide it by 12, you get $100 per month, right? And let's say, for the sake of argument, that today is the end of September, the end of August, for example, the end of August. So how much have you paid but you have not used yet? It will be September, October, November, December, correct? So that will be 4 months. You always make it a point to count your fingers. Otherwise, you're going to get it wrong. So I'm just saying that the financial statements are as of August 31st. If it's as of August 31st, then that means you have paid for September, October, November, and December, 4 months that you haven't used. So 4 times 400 will give you 400. So that's what we're talking about. your prepaid asset is 400, then you need to reduce your expenses by 400. So 1,200, if you reduced it by 400, that will give you what? 800. So that's the actual expense that you have used. Does that make sense? So that's how prepaid works. All right. So now that I have explained to you some of the key adjustments, I'd like to explain to you 2 more adjustments and then I'll stop. Okay? 2 more adjustments. 2 more. Just 2 more. Done depreciation. We've done accrued. We've done prepaid. Let's do four. Let's call it allowance for bad debt. For bad debt. Allowance for bad debts. You sold goods to people on credit. And let's say that when you sold goods to people on credit, you are going to debit accounts receivable, AR, accounts receivable, that's AR for short. Some people call it debtors. It's the same thing. Okay? Accounts receivable is your debit. And you are going to credit either sales revenue, if you have earned it, or some sort of deferred liability, if you have not earned it yet. Does that make sense? All right? So let's say that it was $10,000. On average, in the past, you know that you are going to now differentiate between bad debt, and allowance. Bad debt is specific write-off. This person will not pay. Typically, you know this person or this other company that owes us $200, that will not pay. We know that for a fact, let's say. So that's what we call bad debt expense. Okay? If you know that, then what you're going to do is you are going to debit bad debt, 200, and then you are going to credit allowance, or if you like accounts receivable to reduce the receivable, you're going to call it 200. It's bad debt. It specifically knows. This is the other people that you don't know. But on average, about 2% of them do not pay you on average. So you are going to estimate an allowance. You don't know that for specifically, but you don't know that for a fact. But you know that on average, maybe 2% of them don't pay you. So that will be what? 2% of, let's say, to make matters simple, 10,000. And that will give you 200 also. So, but the debit and the credit is going to be different. The debit is not going to be bad debt, but rather it's going to be, if you like, doubtful debt expense, which some people will say is the same thing as the bad debt. And then this will be the allowance for bad debt, which is 200. Now, sometimes people call this credit loss. Credit loss just means money you don't expect to collect. You don't think you are going to be able to collect that money, okay? This is just saying that your accounts receivable is not 100% collectible. Okay, so how much of it can you not collect? Let's estimate that. Normally the questions will tell you how to estimate that, okay? And the last thing that I want to tell you about adjustment is this concept of unearned revenue. Unearned revenue. This is money that you have received, but you haven't done anything to deserve the money. You are yet to do stuff in the future for it. So you have not earned it. So we call it unearned revenue or deferred revenue liability. So think about it from the perspective of the insurance company. They received $1,200 from you in January. From the perspective of the insurance company, they need to increase or debit cash, and they need to credit what? They cannot credit sales revenue because they haven't performed their services yet, right? So they are going to record it against unearned revenue, also called deferred revenue liability. Because if you cancel the policy they will have to give back the money to you. So the journal entry for money that you have received, but you have not yet earned it, is going to be to debit cash, because you received it, 1,200, from the perspective of the insurance company. And then you are going to credit something that we call unearned or deferred revenue, 1,200. Does that make sense? You have not earned it, so you just need to defer the revenue. And as we step into the future, into time, 1 month you have earned 1/12 of that, right? 2 months, 2/12. That's what you are earning, because it's just an insurance policy. As time passes, you earn it, right? If they haven't put in the claims. Any questions? So you know about the accounting adjustments. These adjustments are very important. Learn it. Ask me all the questions you want. Peace out.